Hello, mortgage fans. So here we are back for another update. I must admit, it's been fairly quiet on the mortgage front in the last week. So it's a good opportunity for me to look at something different and a bit more timely as well. Not sure what the weather's been like your way, but it's spring has very much sprung around us. It's actually very pleasant. All the daffodils are popping out. And normally this time of year, people start thinking about, do I want to move home or do I want to do some work to my property potentially? So this is what I want to focus on this week, is look at if you want to do some home improvements, how that works from a mortgage perspective, and certain things you need to think about. One of the catalysts, aside from the weather, I was very kindly quoted in an article in the Ideal Home magazine by Samantha Partington, very good property journalist. So I'll link that in the notes. You can have a read of that if you like. So that's a bit more high level about the actual property side, as you'd imagine. So what I'm going to look at it in far more detail from the mortgage perspective. So what we'll look at today is sort of how that works. I've broken that down into three sections, which will be the level of equity in your property, your ability to borrow the money, or what we call affordability, and then what type of work is done. And certainly the last one, I'm going to focus on a bit more detail. So in order to do that, what I'll do is just go back over a little history lesson, actually, for all of you mortgage fans. I know you love it. But also one thing that's really, really relevant is that this is probably the perfect time to do this. If you're looking to refinance or remortgage or whatever you're looking to do, if you've had your mortgage more than 2 or 5 years, what you'll find is two things are probably true now, is that mortgage rates are probably cheaper than when you took your mortgage out last time, and your property value is probably higher. So there's a bit of a sweet spot now because house prices will continue to rise, it looks like, so that's great, but also so are mortgage rates. So if you do procrastinate on this or look to do this next year, I can almost guarantee it's going to be a lot more expensive. So it really could be a sweet spot this year in doing that stuff to the property you wanted to do, and I'll explore how we can do that because there's quite a few options. So to kick off then, as I mentioned, a bit of a history lesson. So I always sort of look back at the nature of things and sort of takes us to where we are today, really. So, and it's very relevant in context to this, and I'll explain why in a second. Because if you go back to the history of mortgage lending, it first started in 1775. The first building society was established. This was around the time of the Industrial Revolution. Factories were being built. Lots of property was being obviously built around those factories, and all the workers wanted to club together to start to buy these properties back from the factory owners, hence a building society. See what happened there. So from 1775 that grew. I think by 1825 there was something like 250, very regionalised, often very specific to that actual area or that actual factory. So many of those in place. If you're really into history, you'll know that in 1832 there was the Great Reform Act. So that really took an explosion in one, also building societies, but then secondly PLCs and limited companies as we understand them today. So that's when banks started to come around at that point. Probably the high point of building societies was in 1910. I believe there were 723 of them at that point. But from there on in, really banking sort of took over, and the things I won't go on to now, it's not really relevant. But why that is relevant is through that timeline I just ran you through, what you'll find is the only time you could actually borrow extra money on your mortgage was for home improvements. Banks like that because it improves their security, and it's also just good for you because you're keeping the home in good order as well. So today, I mean, you can borrow for any legal purpose, and I'm sure some people push the envelope on that, and I won't get into our attitudes on debt today. But that just gives you an idea of why banks like it, what the history of it was, and why that takes us to where we are today. So from today, if you do want to do work to your property, as I said at the top, it does split into three areas, which I'm going to explore now. So the first part is level of equity in your property. So one of the biggest dynamics on mortgages are simply how much equity you have in the property, because we're looking at already homeowners at this point, will have a big impact on the pricing. So simply, the less you're borrowing against the property, the cheaper the mortgage is. Very simple. In percentage terms, what you'll find is you need to have at least a 10% equity in your property to consider raising extra money. And if you're borrowing less than say 60% of your property, then you get the cheapest pricing on the market. And then anything in the middle will then be blended. So the cheapest rates are at sort of 60% and below, and the more expensive ones are 90% and down. So that's sort of generally going to be in that bracket. And I'll touch on why that's particularly relevant here as well. So secondly, we'll look at then your ability to borrow, what we call affordability in the mortgage world. So very sort of simple rule of thumb as to what you can borrow. Dependent on your income, you can borrow around about 4.5 to 5.5 times your income. If you're earning, say, over £100,000, that's where you get into that 5.5 times bracket. And I think there are a few banks now will even go up to 6 times income as well. So that's roughly what you can do. Um, I think probably just very briefly, so I don't want to get hung up on the income, because actually it's quite a good video on our website if you want to look at that, or our YouTube channel certainly, that breaks down the different income types in more detail. But all I would say is just a little caveat around if you are self-employed, or if you have bonuses or commission or any sort of variable income, just be careful on that, because not all banks treat that the same. But I won't do that to death now. Just please be aware of that. So lastly then is the type of work being done, and this is what I just want to explore in a bit more detail. And again, this breaks out neatly into sort of three categories also. The first is what I'll classify cosmetic. So that would be things like a redecoration of your home, maybe a kitchen, a bathroom. You're not moving any walls around, so it's sort of fairly straightforward stuff, probably on the lower end of the expense scale as well. Now, how much you spend is very much dependent on you, but this would be around the £5,000–10,000 mark, in that sort of area, typically depending again on the area and what you want to do. I mean, I appreciate some people want to spend, £500,000 on a kitchen, but probably not in this instance. The next one is structural. So if you are moving walls around, whether internal or external, this is where we may need permission from the bank. And this is something that a broker can really help you out with. So this would be things like loft extensions, rear extensions. So you are doing things to the property, but the property itself is staying relatively intact. So again, finger in the air would be around the £50,000 plus mark would be this type of thing. Then the last one is what I would call development. So this is when we're really either knocking a property down, you're gutting it, you're moving lots of stuff around, the fabric of the building is changing at this point. Now, if it's a development loan, most high street banks don't offer this. And one of the reasons why I touched on the building society story at the beginning is that local building societies are brilliant at this type of thing. So we will very often find a localized building society who are really good at this type of lending. Most of them lend nationally now, but there's some really interesting stuff that could be done. And to give some really recent examples from our clients, so if you want to borrow £5,000 for cosmetic work, that's fine. Structural work for £50,000, okay, that's cool, but you do have to pick the right lender and make sure it all works. And then right up to development, and actually helped a client raise about £500,000, doing quite a lot of work to a property in Kensington. So in that development area, because it's not high street lending, also there's a different way of approaching it. What we've done in this instance, which you'll find in most cases is true, is we do something called staged drawdowns, because you don't need all that money day one. And in this particular one, actually, if they did borrow £500,000, it would take it over the property value today, so the bank won't do that. But I think in this particular schedule, there's 6 defined sort of stages within this build. So what the client's doing is they've got some cash themselves, they're kicking off the builders, they're getting started. And then for each of those, so for the next stages 2 to 6, the builders will invoice the client will send the invoice to the bank, and the bank will settle the invoice and increase their mortgage. And at that point, because they're spending so much money on the property, they're effectively doubling the property value. So by the end position, the bank's happy because they're actually borrowing less as a percentage by the end than they are today, but they're working with them through that period. So most people fall into one of those first 2 brackets, if I'm honest. But if you do want to look at that third one, please do speak to a broker, because as I say, it tends to be not high street lenders and people you may not be aware of. It's not overly expensive at all. People are actually quite surprised by how cheap it is. But as you can imagine, the risks entailed in getting it right, that's a sort of very different area. What I'll just say as a sort of quick acid test is, if planning is required, that's when we really need to start engaging with the bank and talking more specifically about what's being done. If you don't need planning, then fine. Most banks are just going to sign off a home improvement loan and you can sort of crack on from there, really. And then lastly are some other points to consider. So I've talked about that very high level in sort of how that works, so the type of work you want to get done. But then you might want to talk specifics about who's going to lend you the money and in what fashion. So this is where could shorter term lending be a better idea? So obviously you can borrow on a mortgage, but people will borrow on a mortgage could be anywhere between 20 years and 40 years. So even though interest rates are low, and I'll touch on that at the end, you are paying the money for a very long period of time. So if you're not doing a lot of work, and maybe you could put that on a credit card or get a personal loan and pay it off quite quickly, you still might find that actually you spend less pounds on that versus a mortgage. That's something we do a calculation on, and again, any good broker will, but that's part of our metrics. We will consider not just a mortgage, but is there a better way of doing things? Secondly, then, your existing product end date is extremely relevant. So in a very simple example, let's say you're 3 years into a 5-year fixed rate. Then a very simple scenario, we might go back to your existing bank and say, look, you'd like to do £50,000 for a loft extension. We add that onto your existing mortgage on a 2-year fixed rate. And then once your 2-year fixed rate and 5-year fixed rates, they all come to an end all at the same time. And then we neatly wrap that all up into a remortgage, either with your bank or with somebody else. That's a very simple example. If there's only, say, 9 months left of your mortgage, we then have to think a bit more carefully about what you do. Do you do that on a penalty-free borrowing? Do you do it as for shorter term lending, as I touched on? Or we could even go down the path of getting what's called a second charge loan. So that's a separate loan that sits on top of the mortgage. So your bank has first charge and you can also have a second charge as well. So second charges are cheaper than certainly unsecured borrowing like personal loans and credit cards. But there's obviously different things you need to sort of bear in mind there. So they're primarily the 3 ways you can fund that, is either with a mortgage, with short-term lending, or with a second charge. And then within the mortgage element as well, do we stick with your bank or go to another bank? So again, another example is you think, well, actually my product's up in April, but I want to do some work to my property. Do you then apply for a larger mortgage today? So again, simple example, let's say you've got £150,000 outstanding on your mortgage. You apply to lender B for £200,000, and then in April, you then get sent a check. Well, it's not a check anymore, it's backs into your bank for the £50,000, and you can do the work you want to do then. So timing's a big factor. What you want to do is a big factor, and how we fund it is a big factor. And I appreciate I've thrown a lot of information around there very quickly, and it does show you that something you might think on paper is really simple, and you can borrow the money through any one of those routes I've mentioned. But why it's really, really important to work with a broker is that we will work out the amount of pounds you're spending, make sure you get the best outcome, and you spend the least money possible. That's what brokers do. We work on your behalf to get you the best outcome. So obviously we're great, but I'll be honest with you, any good broker will be able to do this quite well. And obviously some people do get a bit nervous about borrowing money against their property, because obviously you are increasing the mortgage, no 2 ways around that, or you're certainly increasing your indebtedness overall. But there's normally a sort of rough rule of thumb, is that for every £1 of work you spend on the property, you normally get £2 back in value. And that's very common. So if you did a £50,000 loft extension, you could easily expect that to then boost the value of the property by 100,000. So normally it makes sense, as it does depend on the type of property, the area, etc. But rough rule of thumb, it sort of lives in that sort of area. Last thing around the mortgage side as well is about the loan to value limits I've mentioned as well, because the amount you want to borrow might just push you over a certain threshold and increase the borrowing. So what we look to do is a combination of those things I touched on, is that we might do a certain amount on a mortgage, a certain amount on a second charge, and even on a credit card if you needed to. So you can really blend that out. So there's not a one size fits all. It could be very, very different approaches. But again, we work with you to make sure you get the best outcome. And lastly, I mentioned about the development thing being obviously the most risky, because it's a very good example. If anyone's considering a basement dig out, which have fallen out of vogue, but funnily around my way, a few people are doing it as well, actually. Banks aren't a huge fan of that. And there's a really recent example, I think it was in 2020 in Chelsea. The guy doing a basement dig out not only collapsed his house, he collapsed his neighbour's house. So you can Google that to read that. So obviously in Chelsea, that was a very, very expensive mistake. So that goes back to what I was saying about is working with specialist lenders and making sure you get the right outcome. And obviously in that example, make sure you get the right builder, but we can't help you with that, sadly. And the last thing just to touch on, if you are doing a lot of work as well, just make sure your home insurance is valid as well, because not all standard insurances cover this as well. So again, another little factor just to talk to banks about. So appreciate I've thrown a lot at you there, but hopefully it makes sense. And again, as I keep coming back to, please do talk to any good broker who can help you through this. Now, what's very relevant to this then is what's the cost of a mortgage. So I'll just touch on some market rates and how that translates into mortgages then as well. So market rates are all up last week, which is not surprising. The base rate went up last week, and we're expecting further rises this year. So 5-year money is at 1.58%, which is up 0.3 on the week prior. 2-year money is up at 1.63%, which is up 0.33 from the week before. 3-month sterling LIBOR is at 0.783%, which is up 0.129 just from the week before, and the Bank of England aren't meeting for a little while yet. That information is provided by the ICE and globalrates.com if you want to check that out. So how that translates into mortgage rates then, won't be surprised to learn they're all up. The cheapest rates on the market are variable rates right now. Please do listen to last week's update as to why the 1.14 discount probably isn't a good deal. There's also a tracker at 1.24%. The best 2-year fixed rate is at 1.3. Best 5-year fixed rate is at 1.58%. and buy-to-let start at 1.09. So exactly as I touched on quite a lot through this update, the actual rate you'll be offered would be dependent on your personal circumstances and level of deposit, but they are the cheapest rates typically if you're looking to borrow 60% of your property value or less. Okay, I hope that was useful. I appreciate I did get into the weeds on that one, but if you do want to talk to us or anyone at all, please give us a shout and we'd love to help you on that. And we'll catch up with you next week.